Observe the behavior of the heavy current in this simulation as it encounters smaller, scattered pools of liquid. The larger force doesn't simply flow around them, it surges forward to absorb the smaller pools into its own trajectory. This simulation mirrors the foundational mechanic of institutional order flow. Markets move to seek out and consume resting liquidity pools, regardless of the chart patterns retail traders might see at those same levels. When price approaches a boundary, it might aggressively puncture the level and snap back, or it can descend to a halfway mark, touching it with a flat body. One represents active extraction with surging market orders. The other shows passive limit order absorption. Traders identify the active extraction event on the left as a liquidity sweep, or swing failure pattern, the SFP. The passive absorption event on the right is known as an equilibrium mitigation. Treating these two events as identical leads to entering on market momentum right before a reversal, or placing limit orders at levels the market intends to puncture. Recognizing which mechanic is at work dictates whether you enter with a market order on a confirmed reversal or park a limit order at a specific coordinate. Institutions use the SFP to engineer liquidity by actively hunting stops at known structural points. Price rapidly approaches a major structural high. These green candles show aggressive momentum towards resistance. The extension pushes through the boundary, triggering breakout algorithms. Simultaneously, it triggers retail stop-loss market orders, forcing them to buy back shorts at the worst possible price. This provides the counterparty liquidity institutions need to fill large sell orders. Once filled, support vanishes. The candle body collapses, leaving a long protruding wick. Confirmation occurs when the candle locks below the line, closing back inside the prior range. The trap is set. Bearish SFPs wick above supply to signal a breakdown, while bullish SFPs wick below demand to signal an upward reversal. Because the SFP relies on a sudden momentum shift, execution requires a market order immediately upon the confirmed close. Risk is managed tightly, with the stop-loss anchored exactly at the tip of the wick. The SFP functions as a deliberate institutional tool to extract liquidity by weaponizing predictable retail behavior at structural boundaries. Equilibrium mitigations serve a different purpose. They allow institutions to balance inventory and reload positions without moving price through structure. The process begins with a strong displacement rally, leaving a fair value imbalance. Traders focus on the 50% mean threshold, the geometric midpoint. Price slowly rotates back toward this level. The low velocity of descending red candles indicates a lack of aggressive selling. Institutions use limit orders to passively absorb selling pressure. These orders act as a floor. Price settles against it, absorbing the supply. Mitigation is confirmed when the candle respects the 50% mark, closing with a flat bottom flush against the threshold. In a bullish trend, price tests the midpoint from above. In a bearish trend, price rallies to test the midpoint from below. This setup allows for passive entry, with limit orders parked directly at the 50% coordinate. The stop loss is anchored safely behind the original displacement rally, accounting for the wider structural boundary rather than a single wick. These are highly controlled events that provide continuation by respecting market equilibrium. To trade these setups effectively in real time, you must filter for velocity and volume as the patterns develop. Look at the difference in velocity. On the left, the SFP forms with rapid, jagged vertical movements. On the right, the mitigation pullback moves with slow, rhythmic ticks. The SFP uses speed to trap traders, while the mitigation uses steady decay to absorb orders. Volume profiles are distinct. The SFP shows a massive volume spike, whereas the mitigation shows shrinking volume nearing equilibrium. Finally, HUD telemetry provides mechanical confirmation for both. Context also matters. An SFP against 60-minute momentum is a scalp, but one aligned with the macro trend provides a high torque entry for trend resumption. Real-time diagnosis relies on reading these active intent signatures rather than waiting for a static candle shape to complete. Structural retests function as mechanical interactions with order flow, defined by the specific intent behind the move. This matrix contrasts the two models. The SFP represents active stop hunting with a piercing wick, while the mitigation represents passive inventory balancing with a clean body. The volume row shows the divergence clearly: extreme spikes for the trap and steady decay for the reload. This leads to the execution rules. SFPs require market momentum entries, while mitigations allow for passive limit orders at the midpoint. Risk management shifts from tight, wick-based stops in a sweep to wider, structural stops in a mitigation. By focusing on velocity and volume signatures, traders can move past the limitations of simple support and resistance lines. Distinguishing between trapped stops and reloaded books provides the mechanical precision necessary to execute alongside institutional capital.